Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, talking to you from New York City on this, the 31st day of August, 2021. And I do want to remind you that I'm the editor of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. You can sign up by going to miningstocks.com. Miningstocks.com. We like to also mention Chen Lin. What is Chen buying? What is Chen selling? At chenpicks.com. And also Michael Oliver, who's with me, and we'll be hearing from him in just a few moments, olivermsa.com. And I also want to thank all of you for listening to this show and encourage you to send in your comments, whatever they may be, to questionsfortaylor@gmail.com. We do want to thank our sponsors, as always, for their sponsorship, because that makes this show economically viable. Our sponsors for today's show: Novo Resources, El Oro Resources, Hannon Metals, Labrador Gold Corp, Lion One Metals, SK Mining Corp, NV Gold Corp, and Firefox Gold. I've titled today's show, Fed Taper Talk, Fake Out or Shake Out. David McElvaney, Michael Oliver, as I mentioned, will be with us, and Dr. Roger Moss will be with me in the second segment as well. The Fed has been hinting at a policy of tapering, which means printing less money to buy U.S. securities, which no one in their right mind would want to buy, because the interest rates that these instruments are paying are far less than the cost of everything that's going up. So it's a losing proposition to buy treasuries. So who has to buy them? The Fed. But how seriously should we take the Fed then when they talk about buying less of those securities? Who else is going to buy them if the Fed doesn't? And what happens to the interest rates? I mean, listening to the Fed talk about taper is about as meaningful and about as credible as listening to Dr. Fauci talk about wearing masks. The Fed assured us just before the dot-com crisis, as well as just before the 2008 financial crisis, that the financial markets were sound and under control. Chairman Bernanke assured us that, well, there may be some real estate bubbles here and there, but they are local and as such no real threat to the economy overall. But why then should we take Fed taper talk seriously also when you consider the fact that the slightest rise in interest rates will predictably toss the economy, or at least the stock market, over into a deflationary cliff? Is it simply a matter of cognitive dissonance that keeps us believing in the Fed happy talk when the Fed has no politically palatable choice but to hyperinflate the dollar into oblivion in order to pay off debt that cannot be paid in current dollars? With the handwriting on the wall pointing to an eventual hyperinflation of the dollar, but with annoying disinformation from the Fed along the way, we'll ask David McElvaney to help us make some sense of it all. He'll be with me in the second half of today's show. Roger Moss will be with me just a few minutes from now after our first commercial break to update us on Labrador Gold's very impressive early assay results from its Kingsway project in Newfoundland. That's located right next door to the emerging world-class high-grade gold discovery by Newfound Gold, and that's known as the Queensway project. It's right next to the Kingsway project that Roger Moss will talk to us about. But right now, I'm really happy to tell you that Michael Oliver is with me to help us make some sense of all this insanity that's swirling around. And be sure to go to olivermsa.com, olivermsa.com. Go there and sign up for this excellent newsletter, Michael's Momentum and Structural Analysis, which is one of those must-reads that I see in my inbox, especially every weekend, but through the week as well. Michael, thank you so much for joining me.
Hi, good to be back, Jay.
It's always good to have you. Now, you mentioned that you think there could be some things, a lot of things happening in the markets right now. You talk about the dollar being on the edge. Well, most people say, what are you talking about, Michael? I mean, the dollar seems to be very strong. It seems to be very stable. Why would you worry about a dollar these days? In fact, I'm hearing more and more people say, whenever you bring up the idea that the dollar could be in trouble, they say, yeah, what are you talking about, Taylor? I mean, where else are you going to go? There's no other currency you can go to. So what do you say? You think maybe the dollar could have some trouble?
You got to remember, when you've got competing fiat currencies, it's like, I don't want to use dirty words, but I mean, it's one piece of this versus another piece of that. So their relative value to one another is subjective, and it does change. But the dollar has been in massive decline for the last 40 years. Go back and get a dollar index chart going back to the late 70s, early 80s. Mm-hmm. And you'll see it's one huge collapse, then a big rally lasted a decade, then another huge collapse. Then we had another rally from 2012 through 2015, and then we had another collapse. What we're doing on the dollar right now, if you'll go back a year, in fact, almost 13 months now, July of last year, and draw a line sideways on the dollar index, it's been in about a 3.5% range at the lower end of the range of the last decade, which was also very narrow. It was like 11-12% range. And if you go back through the history of the dollar and try to find me any one-year period like what we've just seen, where the percent high to low was 3% or so, you won't find it. It's dead. In other words, it flopped down. And why does it stop here? Well, there's some price chart reasons. If you go back up to about 15 years, you'll notice there were a couple highs up around 89 on the dollar index. Then when you burst through that, you ran up to 100, 105. This is back in 2015 and 16. Had a nice bull move, and we caught it. And then you finally toppled in 2017 and dropped back down to where? 89 area. April of 2018. So they bought it on top of the old price highs. Then you had a protracted rally all during 2020, and then you dropped back down last summer real hard, back down to where? Under 90 again. Okay? And you've since been in a range from 90 to 93 area, basically, or actually 89 and change to above 93. So call it 3.5% range. Right now, you're 92.5 area. You just dropped 120 points off the high of 2 weeks ago. Our assessment technically is that what's going on here, you can go back to 1988 on an annual momentum chart, which doesn't mean a price chart, but a momentum chart where you measure it versus an annual mean, 3-year average. And there's an uptrend that connects 3 major lows, and now we're on it for the 4th time. But each time we hit this line in the last 30 years, you fired off that line. Now we're not. We're laying on the line. We've been laying on it for effectively 9 months now. So technically speaking, it looks like somebody who fell to the curbstone and can't get up. And people calling this strong, I love it when they do that, because it isn't. It's anemic. It can't get a rally worth anything. It's not even. It's hardly tradable. I mean, if you consider a 3.5% range dynamic, it's not. Now, if we slip down a point below where we are right now, 92.50, 60 area, if we drop down to about 91.50, the price guys won't notice this because it's not back to the lows down there around 90. You get to 91.50 next month, and we're forecasting that you're going to implode. That the dollar's going to then go down to 90, and if it ever hits 90 again, I think they're going to get out of the way, and you'll see the dollar implode deeply down into the 80s, which will be a headline-type event. And it will upset many assumptions that undergird other markets, debt markets, equity markets, and so forth. So, that is a major variable. It's going to be an upsetting variable. And I think one market it won't upset will be gold and silver. And commodities in general, for obvious reasons. But I think the quietness that's in the dollar right now has to be watched. Always watch the quiet guy. Okay.
Yeah. Yep. So, Michael, what you're really saying here then is, I mean, for this argument that everybody's saying, well, you can't. There's no other currency you can go to. What you're saying is, relative to the other they're all bad currencies. They're all destroying themselves. Their purchasing power is going to zero, towards zero. But the dollar technically is looking very vulnerable at this stage vis-a-vis the other really bad currencies.
Yes, and they rotate, but the dollar has been in a degrading pattern for the last, since early 1980s. If you'll just look at a chart, punch it up on a screen somewhere, dollar index, and you'll see a huge 2 major collapses, and I think we're in the process of the 3rd collapse. And I'm not sure how low it's going to go, but I doubt it's going to be the world's reserve currency at the end of this next crisis.
End of this section. Well, of course, there's lots of people that will argue with that one, but we'll leave that for another day. Who knows where things are going to go? The digital people are looking for their piece of the action, and who knows? I only God knows, I guess. Anyway, So gold? You're not worried about gold if the dollar goes down? Gold should have some wind at its back.
That'll help. But remember, don't focus so much on the dollar for gold. This, I think, will help because I think it could be fairly dramatic in the dollar. Mm-hmm. But over the last decade, dollar's been in a 12% range, effectively sideways. Now, admittedly, you're in the lower end of that range right now. But gold doubled in price during that time. It didn't need a bear dollar to go from 1,050 to 2,070.
Yeah, that's true. That's true.
It didn't need a bare dollar, so you don't always need that. But I just think right now this is going to be another helpful little wind at the back of the gold market. I think gold's behaving great, and I think it's also shrugging off all this baloney talk about Powell and the Fed going to taper. Powell wants to get renominated. I don't think he will be, but he wants to be. And if you examine his words he said last week, they were extremely dovish underneath the surface. He was talking about issues like equality and so forth, as if the Fed is now a political instrument.
Right.
He wants to get the renominated, and again, I suspect he won't be, but he's either going to be dovish or there's going to be somebody even more dovish than he is.
All right, Michael, but let me ask you about the equity market, though, because if the money keeps pouring into the system, and even if a lot of it goes out through fiscal transfers to individuals, isn't that bullish, at least nominally, for the stock market?
No. Yeah. There's a point at which throughout history you'll find that the Fed has had a policy of easy money because they had a bust at some point and they wanted to feed the bust back up and it turned into a boom, and they keep the foot on the pedal, but ultimately the market turns, regardless of them keeping the foot on the pedal.
Yeah.
Okay? And it's simply a function of reality. In other words, you get to a certain point where something is priced off the page, and the thing that got it up there, namely monetary policy and Fed funds rates at 0 or 0.25% or whatever for 10 years, it doesn't work anymore because finally reality says, okay, we've had enough. It's not working. And the money goes elsewhere. And I think it started to go into commodities, commodity stocks. It's going into gold. And I think silver's going to gain a lot here, too, more than gold even. But I think there is a movement of money. No, it's not dramatic and draconian yet. But I think it's been subtle and ongoing. And that's why gold is $1,800, not $1,050,
Yeah, exactly. Where
it was in 2015.
Well, Michael, let me ask you then. I mean, if we've got inflation that seems to be accelerating, interest rates are being capped by the Fed. They're trying to defy Mother Nature by pushing interest rates down below. Who knows what the real interest rate would be if the markets were allowed to prevail? So, do you see this as perhaps the event that starts to trigger an equity market decline? Then all of a sudden, the Fed can't control the interest rates anymore.
Yeah, the long end of the bond market, while we've been bullish on the rise in price in bonds since March especially, I think there could be some more, but I think that's largely a temporary phenomenon of asset managers saying, I don't like the stock market so much here. I want to move 5% of capital over here to cash equivalent, the long end of the government debt market. It's not like they're seeking the yields. They're going to park the money somewhere else that they consider safe. And I think they've also been moving it into gold. But ultimately, our technical work says the stock market is likely in a topping process. And I suspect it'll be evident to people even watching price charts by October, meaning 5 weeks from now.
Oh, okay. Well, we have to be on our toes, that's for sure. Watch out those markets. And I guess the message that I always get from you, Michael, is that ultimately Mother Nature has its way. And
absolutely.
You can't fool the markets forever. I mean, all kinds of propaganda out there from every which way, and it seems like not a lot is making sense, not only in the equity markets, but almost every area of our lives these days. But ultimately, reality has to prevail, is what you're saying. So
absolutely, like Rand said, there is an objective reality out there.
Yeah, there is an objective reality, and you can't fool it forever. You can fool it for quite a while. You can fool some of the people some of the time,
which makes it more exaggerated once it comes unraveled.
Yeah. So if we're on the right side of the market when that turn comes, we can do just very well, I guess. All right, Michael, thank you so much for being with us again. Always a pleasure, and we'll look to do it another couple of weeks from now.